Okay, so in this video, also from chapter 6, I'm going to explain the lower of cost or market concept, LCM. We already reviewed the cost flow of inventory in the first 3 videos, right? We identified 3 cost flow methods: specific identification, FIFO, LIFO, and weighted average. So the cost flow is one thing. Another thing is the valuation of inventory. So as we know, in accounting, most things are valued at cost, original cost, and inventory is no different. But every once in a while, we are going to look at our inventory and we are going to see if the value of that inventory has changed. And if the value has changed, and if it's lower than the original cost, then we are going, if the market value, current market value, is lower than the original cost, the one that you have in the books, then you're going to go ahead and revalue your inventory down. Following the principle of conservatism in accounting, we are never going to increase the value of inventory. But we will decrease it so that any loss in value of inventory will be booked in the current period, and so then going forward you could go ahead and realize any original profit margins that you that are associated with that inventory in future periods. Okay, so let me go through these items. Inventories are valued at the lower of cost or market value. I already explained that. This way, loss in inventory value is recognized in the period it actually occurs rather than when it is sold, right? So if you have an inventory that has a value of a cost of $10 and it loses value and it's now worth $5, well, usually when an inventory loses value, it will also, the sales price will also lose value, right? So you don't want to have an inventory that's costed at $10 and then you sell it for $6, and you're going to have a loss as far as gross profits go, right? So rather than wait till you sell it for that to happen, you're going to immediately alert everybody, investors and all financial users, that there has been a loss in value in inventory. And you're going to book it in that period, and then going forward, because you've already lowered your value, you can obtain normal profit margins, or at least you won't have those negative gross profit margins, right? So how do we do that? Well, we're going to do 3 steps as you see here. First, we're going to determine what we're going to use as market value to compare versus our costs. We can use the net realizable value, which is an estimated selling price in the ordinary course of business less reasonably predictable cost of completion and disposal. That could be something like if you have to pay for freight in or freight out, I'm sorry, then you would include it. Replacement cost, the cost to replace the item by purchase or manufacture, right? So that's the actual cost that that inventory has in the market right now. Or net realizable value reduced by normal profit margin. Okay, so as you are going to see, this one is going to be sort of like a ceiling. It's going to work sort of like a ceiling, and this one is going to work sort of like a floor. So if the replacement cost is somewhere in the middle of these two, then obviously you will use replacement cost as your as what you compare. You'll call this the market value. You'll compare it to your original cost, your purchase cost, and then you will use the lower of the two. If replacement cost happens to be higher than net realizable value, then you will use net realizable value as your comparison figure, as your market value to compare to your cost, and use the lower of the two. That's why we call this the ceiling, and you'll see this right now. And this is the floor. So if replacement cost happens to be lower than net realizable value reduced by normal profit margin, then instead of using replacement cost as your market value to compare to cost, you will use net realizable value reduced by normal profit margin. And there's reasons for that, and I'll explain that a little later. These ceilings and floors are implemented by FASB and by GAAP to prevent management from manipulating profits in future periods, right? So there are certain limits that you can do. That way your profits in the future won't be extremely too higher than what they should be, or you won't transfer losses to the next period either. Okay, so one way to do this is you simply place the three choices in order. The highest value will now become your ceiling. The lowest value will be your floor, and the value in the middle will be your market value. So let's take a look at the three cases below as it sees here. So here we have three cases, right? In this case, the replacement cost is right in the middle, so we're going to use this as our market value, and we're going to compare this to cost, and we're going to choose the lower of cost or this of cost or market as our new value for inventory. If the replacement cost happens to be higher than net realizable value, then we will use the net realizable value as our market value and compare it to cost. And if it happens to be lower, then as you can see, this one is going to be in the middle, and we will use this as our net realizable value, which as our market value, which would be net realizable value reduced by normal profit margin, and compare it to cost. Okay, so as I say in step 3, compare the designated market value with current inventory cost. The value of the inventory will be the lower of the two values. Okay, so let's take a look at an example. Sometimes these things are a lot easier to understand when we look at it through data. So our original selling price for our inventory was $15. Our additional cost to sell was $1. Here let's say this is shipping expense. So our initial net realizable value is $14 per unit, right? And our cost was $10. That's the amount that we paid for each unit of inventory. Therefore, our profit margin tends to be $4 per unit. That's our normal profit margin. Okay, so let's say that replacement cost went down to $7. Inventory went down to $7. So if inventory goes down to $7, more than likely the sales price that you can obtain for this item is going to go down as well. And if you see here, I show you that the sales price is now 11, not 15, right? So so if the sales price is now 11 and now 15, so we're going to go ahead and work. Let's just go back and look at this. So the replacement cost is 7. The current net realizable value is going to be 10, right? Which is going to be a sales price of $11 minus $1 in shipping expense. So I can only realize $10 on this item now. And my normal profit margin would be 10 minus what was typically my profit margin, which was 4. Net realizable value minus normal profit margin is 6, right? So my new realizable value is 10. 11 minus 1, as you can see here, and my normal profit margin tends to be 4. So my net realizable value minus normal profit margin is 10 minus 4, which is 6. And so replacement cost falls right in between, so we will use that as our market value to compare to historical cost. So we plug it in here, and our market value will be 7, the replacement cost. Our historical cost is 10, which we stated over here. And so we're now going to value our inventory at the lower of the two. The lower is 7. So our new value for our inventory will be 7, which means this data is for 2010, which means that in 2010 we're going to recognize our loss of $3 per unit, because you want to take your expenses or your losses in the period in which they occur. So what is this going to do? what it's going to do, it's going to permit you to take the loss when it occurs, 2010, and going forward in 2011, you can obtain a reasonable profit margin. So in this case, you're not going to obtain the full $4 profit margin, but it's reasonable. You'll obtain $3. So the purpose of this is to shift losses into the period in which they occur and to permit the company going forward to obtain either normal or quasi-normal profit margins. At least going forward, you're not going to be selling at negative gross profit margins, which is the main goal in doing this. Okay, so let's take a look at another example. In this case, the the replacement cost is 7, right? But the selling price was 13. Okay, so your net realizable value, so the selling price didn't go down that much. So your net realizable value is going to be the 13 minus the selling cost, which is going to be 12. And then you subtract the $4 in normal profit margin that you usually obtain, and your net realizable value minus profit margin is going to be 8. Now if we were to line these up, the number that will fall in the from highest to lowest, this would be the number to fall in the middle. So now we're going to use this as our market value for comparison purposes. So we compare the 8 to the 10, and we go ahead and use the 8 as our new inventory cost, right? Which means we're going to take a $2 loss in 2010. What does this do? Well, if we sell the product for $13 in 2011, we have restored our normal profit margins going forward. Again, the idea is to take the loss up front when it occurs so that in the future you can conduct business as usual and obtain your normal profit margins in the future, or at least something that's semi-normal, not something that would be a ridiculously negative gross profit margin, right? Because if I would have maintained a cost of $10 here, then I would have had a sales price of sales price of 13 minus $10 in cost minus $1 in additional cost. I would have had a profit margin of 2, but it would have been lower than normal. So we want to recognize the loss in value up front. Let's take a look at a third example. So in this case, replacement cost again is 7, but my sales price has gone down drastically for whatever reason. The sales price is $7, which is a pretty steep decline in sales price. In other words, I could only sell this at the same value that it cost me to get. So I must recognize all the loss up front. You know, I can only break even on this item now. So I line these. So my current net realizable value is going to be, my sales price is 7, additional cost is 1. So 7 minus 1 is 6. That's the maximum that I can realize. My net realizable value minus normal profit margin, which as you remember was 4, is going to be 6 minus 4, 2. And my replacement cost is 7. I'm using the same replacement cost. So if we line these up, we will see that the 6 is the number in the middle. So that's what we're going to use as market value. The market value is to compare to historical cost. So as you can see, 6 is lower than 10. We're going to take the full $4 loss up front in 2010, and that will permit us to sell the inventory in the future. We're not going to have a profit because the sales price went down so drastically that there's no more profits left, but at least you've avoided negative profit margins in the future going forward with this inventory by taking the loss up front in 2010. So conservatism in accounting strives to recognize its losses first before gains. Okay? That's the rule of conservatism. We tend to book losses first. Gains, we will book them when they're realized. Losses tend to be booked when they are when they occur, when we know about them. Okay. And here we have another example here. This is just to strive the point that the idea here is that you're going to book as much loss as you have to in 2010 to maintain a minimum profit margin of 0 in the future. In other words, you're not going to get negative profit margins in the future if you follow loss of cost LCM in your inventory. So here the sales price went down even more. The sales price is actually lower than the replacement cost. It doesn't make sense, but I'm trying to give you this example so that we understand the purpose of LCM. So in this case, sales price is 5, additional cost is 1, so current net realizable value is going to be 4, right? Current net realizable value minus normal profit margin is going to be, in this case I got this wrong, it should be 0, right? 4 minus 4 is 0. And replacement cost is 7. So if we line these up, this is going to be the number in the middle. We'll use this as a market value, compare it to historical cost. That's going to be the lowest, so you're going to use this as your new inventory value. You're going to recognize $6 in loss in 2010. And so when you sell the units, you will sell it at 5. Your cost was 4 now. That's your new inventory cost. Additional cost is going to be 1, and your profit margin is going to be 0. So you're going to obtain the same 0 profit margin in both cases. That's going to be the floor of future profit margins. And in 2010, you're going to recognize losses of 4 per unit here in this case, and of 6 per unit in this case. So what I say here is that these rules limit the profit margin for the next period to a maximum of normal profit margins 4 and a minimum of 0. So that's the purpose. The purpose is to take the loss up front, but GAAP and FASB implement a ceiling and a floor, and the logic behind that is to limit future profit margins to 4. Oh, my little son is waking up, so hopefully he'll let me conclude this video. I apologize if you could hear him in the background. And we're going to limit the maximum profit margin in the future to the normal profit margin, which is 4, and the minimum profit margin in the future to 0 if we follow this method. Okay, so that is lower of cost or market. Another major inventory concept that you have to learn along with the cost flow concept. Okay, so I hope this was helpful. I gotta go because my 4-month-old is waking up and I'm taking care of him. Okay, thanks a lot, and if you have any questions, just ask me in class.